Hey guys, this is Scott Horne of the Owner Finance Network, and we're going to have some fun on this one to just talk briefly about some creative down payment strategies. And yes, you can get creative on this stuff. So if you find the video helpful, take a minute and like it, guys. We appreciate you doing that. Don't forget to subscribe to our YouTube channel and make any comments down below. We'll do our best to comment for those for you. So down payments, deferred closings. Can we do that? Absolutely, we can do that. We can do almost anything within the rules of the state of where you're located. But one thing I think is important about down payments is there is a direct correlation between down payments and a borrower's, how they take care of the home, how they make their payments and things of that nature along the way. But can we defer part of the down payment? Certainly. So for instance, if I'm asking a 10% down payment and my buyer might only have, let's say, 5, 6, or 7% and not the full 10, can I still do the deal? Well, the first thing I'm going to do is make sure that they look good on paper. That means their application looks good. Maybe I've got them pre-approved through my loan processor in some format. If they look good on paper, I'm probably okay with doing that. I just don't want to record my mortgage until they've met some certain guideposts along the way. Maybe it is they can make the balance of that down payment over 6 months, 12 months, 18, 24, whatever it might be, and then I'll record their mortgage for them. Maybe they make extra payments each month along the way on that deferred balance, whatever that might look like within their budget. And I give them that option to do some things out there. But if you're going to do that, you need to make certain that your transaction is contracted for and structured properly that gives you the ability to do that. Again, don't get out there and stub your toe, screwing it up somewhere along the way. No, in Texas, we have some issues about that where you need to be very cautious. Maybe you have to terminate your contract after day 179 so it doesn't become an executory contract. You don't have that problem in really any other state out there but Texas to deal with that. But once the buyer has met this provision, I can go ahead and record them in the mortgage. Maybe if I feel comfortable enough, and maybe I got, let's say, 7% down, I put the 3% in a second lien type mortgage to the borrower. And maybe they pay that off, as I said, in 6, 12, 18 months, whatever it might be, with monthly payments, quarterly, whatever it might be. But there are mechanisms to structure that. I've heard people talk about bartering. Well, I don't really barter for an asset out there. I don't want something else per se. Although I have taken a Porsche once for a down payment. It wasn't a bad idea. Until I got home and showed it to my wife, then it wasn't quite as good as I thought it was going to be. Imagine that. Wives and money, But could you barter? Maybe they own another piece of real estate they could give me a lien on for some protection. That could work also. There's all sorts of ways you can look at along the way that could work out there. I just don't see many of those working out very well. But based on some circumstances, you can do that. And you simply create that and want to show that as a down payment, whether it's a car, like I said I took earlier, or some other mechanism. Can you provide a buyer a credit for work done on a property? Certainly. Maybe you create a first and a second lien mortgage on a property. Maybe you defer recordation of those mortgages along the way. And the buyer's going to go in and maybe paint the outside, paint the inside, maybe put in new appliances, put in flooring, whatever it might be that would cost you $10,000, $15,000, $20,000 to do. And when all that is done and inspected, you reduce their second lien by the amount of those items being completed. You can do that very easily in writing, and when it's all done, you can release that second lien against them. And they actually now have built in a legitimate down payment to the transaction. So that is a good way to do that. Oftentimes we call that a work for down payment. You just want to be cautious of that, the neighborhood who your buyer is, to make sure they have the ability to do the work. In my early beginnings as an investor, we did a lot of work for down with people who had no ability to do this stuff. They all thought they could, and they didn't. And I bet you we had a 25% default rate or higher. Today, when I do that, my default rate is almost zero because we're vetting our buyers out there, their abilities. We know what's going on, and we feel very comfortable with those kind of things. Another way to come up with a down payment or security that is needed is you get a guarantor on the mortgage. Maybe your buyer can't qualify for some reason. You might need a guarantor who can come in that helps you get to the level you need to be. You can look at that from various sourcing out there, but I find using a guarantor, I can't speak, a guarantor or a cosigner can work, very well in your advantage, because that guarantor does not want to see that buyer default, because they could be liable for that default. And oftentimes they will help and ensure that that buyer is going to make their payments, maybe take care of the improvements, pay that additional down payment along the way to get that added comfort zone you need. And as an investor who's selling a home, the more money I have, the more comfortable I am. The more resources I have to protect me, the more comfortable I am. And I think it's just understanding those kind of things that will help you get to that final point rather than having your house just sit, which means it's open to vandalism. It takes time and money to take care of the yard, to pay utilities, on down the line, and just drains you of money. So I'm always trying to find a way to get my properties income producing as quick as possible for all of those reasons. And guys, there's always pros and cons of this that are out there. The positives are you get your property occupied, you get it income producing, which is very important. And if you do that with the right person, you usually wind up with a pretty good deal along the way. They will perform and do it. However, can buyers fall on their face? Absolutely, and it does happen, unfortunately. Even though you go through all the proper steps along the way, bad things happen to good people, and you wind up having to take the house back. And nobody wants to do that. And you would hope that people would work with you, and they don't want to get evicted or get foreclosed on. But there's always what I call the idiot factor in the marketplace. People, they just kind of hide their head in the sand, and you're stuck doing whatever it is you have to do. But I have found historically, when you are working with a down payment with a certain marketplace or a certain house in a certain condition neighborhood, you have to have the ability to massage those down payments, find some creative ways sometimes to get what it is you're looking for, maybe find some additional creative ways to protect yourself. And when you do all that, most of the time, you can wind up with a pretty good deal. But sometimes it can raise its ugly head and nip you in the bud as well. So guys, hope you all found this video helpful. If you did, take a minute and like it. Don't forget to jump over and subscribe to the YouTube channel. Make any comments below. We'll get them back to you on those. We'll look forward to seeing y'all next time.